Most people think taxes only show up when you sell something. So when a tax form arrives for an investment you never touched, it feels like a glitch. It's not a glitch. It's how funds pass income through to you. By the end of this video, you'll be able to look at any exchange-traded fund you own and answer 3 things. Why it can create a tax bill even if you never sold, roughly how big that bill could be, and which screens and documents tell you it's coming before the surprise hits. Let's use one realistic example the whole way through. Say Jordan owns $25,000 of a broad stock exchange traded fund inside a regular taxable brokerage account. Jordan did not sell all year. In early January, Jordan gets a tax form showing $520 of taxable income tied to that fund. Jordan's first reaction is, how did I make income if I didn't sell? Here's the mechanism. A fund is not just one stock, it's a basket. And inside that basket, money comes in. Companies pay dividends, bonds pay interest, and sometimes the fund itself sells holdings inside the basket, which can create a gain inside the fund. The key point is this. Taxes in a taxable brokerage account are triggered by income that happens inside the fund, not only by you selling your shares. You can think of it like owning a rental property with a property manager. Even if you never sell the property, rent still comes in. And rent is still taxable. A fund works similarly. Income shows up and it gets passed through. That pass-through part is the first place people get tripped up. When an exchange-traded fund receives dividends or interest, it does not just sit on that cash forever. Periodically, the fund distributes it to shareholders. A distribution is cash, or sometimes reinvested cash, that the fund pays out to you. If you have dividend reinvestment turned on, you might not see cash hit your bank account. It can buy more shares automatically, but the tax system still treats that distribution as income in the year it happened. So Jordan's $520 was not a sale gain. It was mostly distributions. And there are 2 main buckets of taxable distributions you'll see. The first is ordinary income, like dividends and interest. The second is capital gain distributions, which happen when the fund sells something inside the basket for more than it paid. Now, one important nuance. Exchange-traded funds are often more tax efficient than traditional mutual funds because they can use in-kind redemptions to manage internal gains. That's why many broad index exchange-traded funds rarely pay capital gain distributions. But rarely is not never. You can still get dividends in almost any stock fund. Bond funds can throw off a lot of taxable interest. And some exchange-traded funds do distribute capital gains, especially actively managed strategies, commodity and currency exposure, niche segments, or situations where the index changes force selling. So, the first intermediate level takeaway is this. If your fund is designed to hold income-producing assets, you should expect taxable income even if you never sell. Now, let's make Jordan's numbers feel real. Jordan's $25,000 holding produced $520 of taxable income. That's about a 2.1% distribution for the year. That does not mean Jordan earned only 2.1%. The share price could have gone up or down. This is just what flowed through as taxable income. If Jordan is in a 22% federal tax bracket and the income is mostly qualified dividends, the federal tax rate could be lower. If it's mostly ordinary dividends or bond interest, it could be higher than you expect. Jordan's actual federal tax might land somewhere in the rough zone of $80 to $120 on that $1,520, depending on how it's categorized. State tax can add more. The important point is not the exact dollars. It's that the tax bill is based on the distribution type, not on whether the share price went up. This is where people misread their brokerage activity. They look at their performance screen and say, I didn't sell, so there's nothing taxable. Performance is about price movement and your own trades. Taxes in a taxable account care about 3 things: dividends, interest, and realized gains that were distributed to you by the fund. Now, let's talk about the moment that creates the confusion. On the day a fund makes a distribution, the share price usually drops by roughly the same amount. That's not a loss. It's math. If a fund pays out $1 per share, the fund has $1 less in assets per share right after the payout. So the price adjusts downward. If you reinvest, you get more shares at the new price. Total value tends to stay roughly the same, all else equal, but you still owe tax on that $1 distribution. So Jordan sees 2 things that feel conflicting. A tax form says Jordan had $520 of income, but Jordan's account value did not jump by $520 on that day. It might even look flat. That's normal. You got cash out and the price adjusted down. Now, here's the part that separates intermediate viewers from everyone else. Not all distributions are created equal. Some are qualified dividends, which can be taxed at a lower rate. Some are ordinary dividends or interest, taxed like normal income. Some are capital gain distributions, which are usually taxed like long-term gains if the fund held the underlying assets long enough. And sometimes a portion can be return of capital, which reduces your cost basis instead of being taxed immediately. Your tax form will break this down, but you can often see the categories in your brokerage's tax center before the forms arrive. That leads to the first signal you can watch before tax season. Signal 1 is the distribution type and timing alerts. Most brokerages have a corporate actions or distributions page, and many will show upcoming dividends and capital gain distributions when they are announced. The timing detail that matters is the record date and the payable date. The record date is the cutoff for who gets the distribution. The payable date is when it hits your account. If you buy the fund right before the record date, you can receive the distribution even though you did not hold the fund for long, and you still owe tax on that distribution in a taxable account. That surprises people every December. They buy a fund, get a distribution a week later, and then wonder why taxes went up. So, Jordan's first check is simple. Open the brokerage tax center or distribution screen. Look for year-end distribution notices and note the record date. That is the first. This might show up on my taxes alert. Now, signal 2 is the one that tells you the magnitude. It's the fund's distribution history and its year-end estimates. Most exchange-traded fund providers publish a distribution schedule and a history page. Around late fall and early winter, many also publish estimates for year-end distributions, especially for funds that tend to pay capital gains. If the provider posts an estimate like expected year-end capital gain distribution of 3%, that's a big deal in a taxable account. A 3% distribution on Jordan's $25,000 holding would be about $750 of taxable distribution. Again, your account value may not rise by $750 because the price adjusts downward. But the tax system still counts the distribution. This is where the viewer's decision table starts to matter. If you are holding a broad stock index exchange-traded fund, the capital gain distribution risk is usually low, and the main taxable piece is dividends. If you are holding a bond fund, a covered call strategy, or an actively managed fund, the taxable distribution can be much larger and more ordinary. So the second check is practical. Search the fund name plus distribution history on the provider's site. Look at the last 3 years. If you see a recurring large year-end payout, you should treat it as part of the cost of holding it in a taxable account. That's not a judgment. Some people accept that cost because the strategy fits their goals, but you want to know it before it hits. Now, for signal 3, which is the one most people never look at. Signal 3 is portfolio turnover and embedded gains pressure. Turnover is how often the fund's holdings change. Higher turnover means more buying and selling inside the fund. That can raise the chance of realized gains being created inside the basket. And embedded gains pressure is what happens when a fund holds positions with large unrealized gains, then is forced to sell, either due to index changes, strategy shifts, or redemptions that cannot be handled efficiently. You won't get a perfect number for embedded gains from every provider, but you can read the clues. Look at turnover percentage in the fund fact sheet. Look at whether it is an index strategy or actively managed. Look at whether it holds assets that throw off a lot of income. Then match that to your account type. Now let's bring Jordan back in, because this is where people make the wrong inference. Jordan sees the $520 of taxable income and thinks, this fund is bad. But it might not be. If that $520 is mostly qualified dividends on a $25,000 holding, the tax cost may be relatively modest. The real danger zone is when the distribution is large, ordinary, and unpredictable, like a fund that pays out 8% in a year, mostly as ordinary income, or a surprise capital gain distribution right after you bought in. So, let's translate this into options, not advice. Option 1 some people consider is choosing which account holds which type of fund. Income-heavy funds, like many bond funds or high distribution strategies, often create more annual taxable income. Some people prefer holding those inside a retirement account where the income is not currently taxable. Stock index-style funds that are tax-efficient are commonly held in taxable accounts because the annual tax drag can be smaller. The trade-off is access and rules. Retirement accounts have withdrawal rules and penalties in some cases. Taxable accounts are flexible but expose you to yearly taxation on distributions. Option 2, some people consider, is picking funds with a lower distribution footprint if they want more tax stability. That usually means lower turnover, more tax-efficient structures, and less reliance on option income or short-term trading inside the fund. The trade-off is strategy. You might be giving up a strategy you like in exchange for steadier taxes. There is no universal winner. Option 3 is simply planning for the timing. If you know a fund pays a year-end distribution, you can treat it like a calendar event. That can affect estimated tax payments or paycheck withholding if you have enough taxable investing income. That's not a directive. It's the idea of avoiding an April surprise by knowing what your own holdings tend to do. Now, there's one more misread worth fixing. People hear, you can owe taxes without selling, and assume it's the same as being taxed on price gains. It's not. A distribution is real cash flow out of the fund. Even if reinvested, price gains that stay inside your holding are generally not taxed until you sell in a taxable account. So you have two separate tax channels. The distribution channel hits you annually. The sale channel hits you when you sell. Jordan's $520 came through the distribution channel. If Jordan also sells later for a profit, that is the sale channel on top. So, if you want to estimate your tax exposure from a fund without doing anything fancy, you can do a simple back of the envelope. Take your holding value and multiply by the fund's typical annual distribution yield. If Jordan's fund tends to distribute around 2%, then on $25,000 you expect around $500 of taxable distributions in a typical year. Then consider what type it is. If it's mostly qualified dividends, the tax rate might be lower. If it's interest or ordinary income, it could be closer to your regular income tax rate. If it's a large capital gain distribution, it depends on your situation and how it's categorized. You don't need perfection. You need order of magnitude. One more practical wrinkle is state taxes. Some states treat interest and dividends differently. Some funds also hold government bonds where a portion of the interest can be state tax exempt. You usually see that broken out in the year-end tax details from the fund provider. So if you live in a high-tax state, the same distribution can feel very different depending on what is inside the fund, even if the dollar amount is identical. Now we can land this with a 2-minute checklist. Because this is a video, you should be able to act on in one sitting. First, open your brokerage tax center and find the section for dividends and distributions for the current year. Second, look for any year-end distribution notices, especially around November and December, and note the record date. Third, go to the fund provider's site and pull up the distribution history for the last 3 years. Fourth, check whether the fund has a pattern of large year-end payouts and whether those payouts are mostly ordinary income or capital gains. Fifth, look at the fund fact sheet for turnover and for the type of assets it holds, because high turnover and income-heavy holdings are the big clues for higher tax drag. Sixth, confirm whether dividend reinvestment is on, and remember that reinvested distributions are still taxable in a taxable account. Seventh, when tax forms arrive, compare the categories, not just the total. Qualified dividends, ordinary dividends, interest and capital gains do not hit the same. And eighth, if you are planning a big purchase or loan application, remember the timeline. Taxes are not just about what you earn. They are about when the income is recognized, and that can change your cash flow month. If you can do those checks, you won't be surprised by the tax bill you didn't earn. You'll see it coming. And you'll know whether it's normal dividends, an income-heavy strategy, or a rare capital gain event. If this helped, subscribe to the Wealth Blueprint for more clear money breakdowns. And leave a comment with the next topic you want covered, or the one part of today's video you want explained even simpler.